This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. It is not intended to cause or induce breach of an existing agency agreement.
Hello? 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 This is the Vancouver
Commercial
Real Estate Podcast.
And welcome back to the Vancouver Commercial Real Estate Podcast. I'm Cory Wright.
And I'm your other sometimes host, Matt Scalina.
Well, I'm not going to lie to Matt. I didn't sleep last night. I was so excited for this episode today. I know we've got Doug Porter. Does it get any bigger in the economy world as to having Doug Porter? Why he takes time to talk to us, I couldn't tell you.
And we don't ask.
We don't ask. He just says yes. We get him on as quickly as possible. By far the most requested guest. I get emails quite consistently from listeners asking when he's coming back on. Chief economist, you'd say.
Chief economist at
BMO.
Yeah.
It's just like, does it get any bigger than that? We've had Doug on a couple times, and he's been so insightful, outlining everything that goes into it. And he really dives in like the underlining stuff that really affects how inflation works, how rates work, where rates might go. Usually when we're doing these podcasts, I'm sitting there rambling off questions. But this one, I'm more listening. I get so entranced in what he's saying, trying to absorb it all. You just run with it, which is great. So I appreciate it. Thank you for doing that.
Well, no, you know what? I just had a lot of questions, and yeah, it was great having Doug on the show. It's I feel like I've said this on the Vancouver Real Estate Podcast, but some guests, you're just like, I can't believe I have a half hour to ask this guy whatever I want.
Oh, I know. It's amazing.
That was,
and they're sharing their insight, and when they're looking at this from a national level and a world level, like an international level, and just how things get broken down and what is what, like it's so insightful. There's so much to take away every time we have Doug. We're just so appreciative of him joining us as he does.
Absolutely. Before we get to that, Cory, one thing I just want to mention, because I don't know if you're up to date. I know you've bought new shoes for the run. October 6th at 3 p.m. Jaden Lee's running from BC Children's Hospital all the way to Chilliwack, the long route, 100 miles. He's trying to raise $150,000 for BC Children's Hospital. I just wanted to say, because I know that you, as I understand, you're showing up 3 sharp to start the run.
Oh, is that my schedule? Okay.
I've just been told by Jaden. Now, this is a bigger deal than I thought.
Okay.
So he has his last appointment at 3. There's now going to be outside of the hospital a 3 to 6 p.m. party.
Oh.
Okay. So you're not running at 3 anymore. But you should still come to the party. Then he's going to take off after doing a bunch of media. He's going to start his run. There's police escorting him all the way. So we're talking 26, 27 hours, however long this is going to take. He's got a police escort from Oak Street all the way to Chilliwack. There's an ambulance that's following just in case.
Well, that's because they knew that I was going to be there.
Specific reason for the
We lost one of the runners in a bush.
Man down.
He's not getting back up.
So I did just want to bring that up before we cut to our talk with Doug Porter, because there is an easy way to get involved. You can obviously run, and there's going to be spots along the route where you can join up with all the people running with Jaden. But if you're interested in donating, and I think everybody should, it's hard to not get behind BC Children's Hospital. Head over to either Instagram and go to _Jaden Lee. That's JAYDENLEE. And there's a link on his Instagram page. There's also one at Vancouver Real Estate Podcast. We have a link to his secure BC Children's Hospital page, or you sign up for the live wire at VancouverRealEstatePodcast.com. And there's a button there. I hope everybody gets behind it. It's a great cause. He's doing wonderful things for that place.
Yeah, no, it's amazing to hear that it's going to be such a huge event, that there's that event there after from 3 to 6. I'm 40 now, and I have running legs that only are good between 3 and 4. So because of that, which it's phenomenal to hear
for that 3 to 4.
That's my only window, right? So I'm glad to hear the event's been so successful and going to be so big. We won't be able to run at 3 and 4, but I will gladly step aside during that running at peak hours for me to allow that event to continue on and to have a tremendous outcome.
How gracious of you, but maybe we should cut to our talk here. It's, would you say this is action-packed half hour with Doug Porter?
I would say if you have any level of interest, whether it's finance, real estate, or if you have two legs and a heartbeat in North America, this is the episode you need to listen to, because we're going to pretty much spell out what's going to happen over the next 24 months.
Doug Porter, Chief Economist at BMO. Enjoy.
This podcast is presented by Impact Commercial.
Impact Commercial. John, Alan, the team over there are fantastic. They've all been on the show.
They have, yeah.
Friends of the show.
Great guys.
Wealth of experience. They can help with all your commercial financing needs.
Whether it's owner-occupiers, land development funds, commercial investments, or multifamily, these guys got you covered.
And they recently obtained their CMHC correspondent lender status.
So for all your commercial lending needs, visit them at impactcommercial.ca.
That's impactcommercial.ca. Okay, we're here with Doug Porter, Chief Economist at BMO. How you doing, Doug?
I'm doing well, and thanks for having me.
Yeah, no, thanks so much for taking the time. We really appreciate it. We always start our show by asking our guests, can you tell us a little bit about yourself?
Yeah, sure. I've actually been an economist for my entire career. I know that sounds very exciting. I started at the Bank of Canada back in the early 1980s, but I've been on Bay Street since 1984. Most of the time, not all of it. Most of it has been with the Bank of Montreal, and I've been a chief economist here in Toronto with the bank for a little bit more than 10 years. I manage a team of about 16 people. A couple of whom are now in San Francisco. We just recently acquired the Bank of the West, which is now part of BMO. So we have a small economics group in San Francisco now. And I would assert or suggest that we're probably the best economic shop in Canada.
Well, Doug, like I said, for those who listen to the podcast, you need no introduction. We appreciate you taking the time. By far, the most requested guest we always get is to have you back. So we appreciate that. So I guess I'll lead off with the questions. I know we've been looking forward to this. What's going on? How interest rates are up? Inflation seems to be up over last month's stats. Can you maybe just give us a quick, just broad strokes of just where we're at right now before we can sort of dig into some stuff in more detail?
So I think the really big story, and arguably this has been the economic story for 2023, is just how resilient the North American and the global economy have been. When you think back to a year ago, it was pretty much conventional wisdom, and I would say the consensus forecast that North America and Canada specifically were going to go through at least a mild recession this year. That has not happened. I'm not going to tell you that the Canadian economy has been a ball of strength. It hasn't been, but it's held up better than I think most expected, and definitely the U.S. economy has held up better than expected. And mostly as a result of this, we find ourselves with higher interest rates than I think anybody really expected a year ago. The Fed, has made no promises about being finished raising interest rates. The Bank of Canada has made no promises. And maybe the major story here in the last couple months in financial markets is that long-term interest rates, bond yields are just grinding higher. And, for instance, as we speak, 10-year yields in Canada and the U.S. are at levels that we haven't seen since 2007. So basically, you have to go all the way back to before the global financial crisis since we've seen yields at these kind of levels. And, just to put in perspective, like recently we had the 10-year yield in the U.S. touch 4.5%. It was just 4% at the end of July. It was 3.5% back in May. That is arguably one of the most important interest rates in the world. And it's gone up by roughly 100 basis points in a matter of a few months. That's a big deal. And again, a lot of it just goes back to this underlying theme of economic resilience. And frankly, what that means is higher rates for longer.
How do you think about the resilience, Doug? Because I think it's caught everybody a little bit off guard. What accounts for the resilience in the North American and Canadian economy?
Well, there are a few things to point to, but I would say the overall story has been the consumer, and a lot of it just goes back to the fact that consumers in both Canada and the U.S. were sitting on a lot of savings after the pandemic. Now, And I still believe there was a lot of pent-up demand, too, for things like travel and entertainment. I mean, look at the demand for Taylor Swift tickets. Maybe that's a bad example, or rather specific example. But there's a lot of demand still for travel and entertainment in particular. And, as I said, consumers were sitting on a lot of savings. We knew that coming into this year. We just didn't know how that would stack up against the big rate hikes that we've seen. And so there was a bit of a debate who would win that battle. And it's pretty obvious that pent-up demand and the extra savings dominated the rise in interest rates. And so I think it really does simply go back to the consumer. I think the other piece of the puzzle is that the labor market is still pretty strong. And we'll get into this later, I think. We have seen some softening in the labor market, a little bit around the edges. But the big story there is we've still got one of the lowest jobless rates that we've seen in decades in both Canada and the U.S. And, even though there's been some cooling, we've still been adding a lot of jobs in both economies. So underlying income growth has remained relatively firm throughout this episode. And so, ultimately it's been the consumer who still managed to slog ahead, even in the face of a dramatic run-up in interest rates.
Doug, do we kind of nail the soft landing, or do you see Canada heading into a recession either by the end of this year or early 2024?
So I personally still think that's very much an open question. At some point in recent months, we've seen Wall Street almost act as if the U.S. has achieved a soft landing. There have been a few more questions about that in recent weeks. Because there's a lot of new risks that are out there for the economy. But I would say up to this point, this is, I think we have been close to so far having a soft landing. But the reality is with an economy is the flight never really ends, right? Once you get to one spot, you keep moving forward one way or another. So it's not guaranteed that what's been a soft landing so far will remain so. And I think there is a little bit of a distinction between Canada and the U.S. We actually do have a somewhat weaker outlook for the Canadian economy than the U.S. economy. And much of that goes back to the vulnerability of the household sector here in Canada to the run-up in interest rates. We have a lot more household debt in Canada than they do in the U.S., and that's a relatively new phenomenon. That was not true 15 years ago. And our debt turns over a lot faster than the U.S. A lot of Americans, of course, have 30-year mortgages. We don't have that here. And so a run-up in interest rates will affect the Canadian consumer a bit more harshly and a bit quicker. And so we suspect the consumer is more likely to crumble here in Canada than in the U.S. So I still think it's a little bit of an open question. We don't officially have a recession in our forecast. I would almost call it a recessionette. We've got a couple quarters of negative GDP, but they're not back to back. So it's more like a 1 year period where the economy struggles to see any growth whatsoever. And we do look for a little bit of a further rise in unemployment, but it really doesn't rise to the definition of a recession. Meanwhile, in the U.S., in our official forecast, we don't have a single quarter of negative GDP. Make no mistake, we don't see strong growth, but we just don't think the consumer is going to be under as much strain as it will be in Canada because of that. The lower level of debt and the fact that they're locked in for a longer period of time. So we actually see the U.S. economy stumbling through with modest growth. And I guess if I had to define it, I would call what we have in our U.S. forecast as a soft landing. And by the way, last comment I'll make on that is that's a question Jerome Powell, chair of the Fed, gets asked all the time. Is that a soft landing and that you've got in your forecast? And he will not use that term. He's not that confident. And, frankly, there's just such a range of possibilities, and there's a lot of different risks out there facing both the Canadian and the U.S. economy. I don't think anybody's quite willing to stick their neck out and say that, yes, we have definitely reached a soft landing. But I would say when we look back over the past year, as I said earlier, I think the economy's held up a lot better than we could have realistically hoped for a year ago, given the dramatic run-up in interest rates and the kind of inflation we've been dealing with.
And can we just play out the next year in Canada? Because, I'm hearing higher for longer, a struggle through the next year. Is this more like in a weird way? I mean, I guess Cory and I are both in the real estate world, so it's impacted us more dramatically than others, but it feels like we've been purgatory for a while here. Just, when does this end? It sounds like in your mind, we got another year of kind of struggling through with seemingly data points that don't give you a clear indication of where we're headed.
Yeah, and I think now is the time to turn to the inflation and the interest rate outlook, because really that's going to determine whether we ultimately do go into something, a bit more of a harder landing, and exactly how long rates are going to have to stay at this level. It really does come back to inflation. And unfortunately, we've now had 2 months in a row where Canada's inflation rate has ticked up. As a reminder, we got as low as 2.8% back in June. That actually was within, just barely, but it was within the Bank of Canada's so-called comfort zone between 1% and 3%. But unfortunately, largely because gasoline prices have turned from being a friend to a foe, we've now got a 4% headline inflation rate. And maybe most disturbingly, we actually saw a little bit of a pickup in underlying or core inflation in August as well. And, the Bank of Canada just can't be comfortable with that. The fact that inflation is both above the high end of their comfort zone of above 3%, and even underlying inflation looks like it's starting to pick back up again too. So, above and beyond whether the bank hikes one more time or not, I think the main message is they're going to have to stay at fairly high levels for some time. One change we've made to our forecast is we actually don't see them cutting interest rates now until the second half of next year. And even then, unless the economy really weakens abruptly, even then, I think it's going to be sort of a slow step down the staircase in bringing rates down. I don't think they're going to slash them. I think it's going to be a relatively slow grind down. And I guess the last piece of the puzzle is, where do rates ultimately settle out? When we're on the other side of this inflation episode, like how low will rates get? Are they going to go back to the kind of levels that we became used to before the pandemic? And I think the answer is no. I don't think they're going back to those kind of levels. I think that period was an outlier. The decade before the pandemic. Keep in mind that we were still dealing with the aftermath of the global financial crisis and all the banking crisis in the U.S. And rates were probably unnaturally low for the decade before the pandemic. So if we think of the Bank of Canada's overnight interest rate, this is pretty closely tied to all short-term interest rates. Right now it's 5%. We would expect on the other side of this, so when we look at, say, about 2 years from now, we would expect it to gravitate back to a range of about 2.5% to 3%. So, considerably lower than we are here today, but not down to the kind of extreme lows that we had in the decade before the pandemic.
Doug, as Matt alluded to, we were in the real estate side of the business and obviously interest rates have had an impact on it. I think we would both kind of say the housing market, maybe BC focused, and the commercial markets over here have definitely been much more resilient, I think, than most people thought going into this. What is BMO's? What are you guys seeing on a national level? Has the real estate market maybe been more resilient than everyone thought, considering the run-up in interest rates as quickly as that took place?
I would say the short answer is yes. It has been more resilient. It's interesting, and it's kind of odd to say that, given the fact that national home prices, if we look at the Real Estate Association's home price index, they actually did correct from the peak in early 22 to early 23 by a little bit more than 15%. I mean, that is a very serious correction. But I would say, if anything, that was less than many of us expected, given the kind of interest rate hikes. Like we and others were looking for a national decline of 20 to 25%. And of course, there are big differences regionally in terms of both that forecast and what actually happened. And, there are a number of cities that didn't see anything like that kind of decline, like Calgary. Calgary prices are actually higher than they were, at the national peak in early 2022. So that means some cities saw, much more severe correction than that. I would say BC did better than average. It wasn't quite in Calgary's league. But if I look at Vancouver and even Victoria to some extent, that area held up better than, say, central Canada, especially Ontario. Now, Ontario had the biggest boom during the pandemic, and it's had the biggest hangover since. So Ontario's been, sort of the high beta region of the country. But I would say if we look at it nationally, we did get a nice little, prices started to come back during the spring and in early summer when the Bank of Canada, it looked like they might be done raising rates, which I think astonished a lot of us how quickly the housing market started to get back up off the mat again. And frankly, I think that's one of the reasons why the Bank of Canada started to raise the interest rates again, because housing did look suddenly so resilient. So, it's almost like the real estate industry has to be a little bit careful what they hope for.
Right.
Because, the bank is watching real estate very, very closely. And if real estate is a bit too healthy, then, that actually raises the risk that the bank might raise rates further again. That's certainly one aspect of, or one thing that's going to go into their decision of whether they actually do ultimately have to raise rates one more time or not.
Doug, have we seen the bottom in the residential and commercial real estate markets? I know. I heard the past tense there a couple times. I don't know if that suggests as much.
So, excellent question, and one I'm not 100% confident answering. And ultimately, of course, this is the question that matters, I'm sure, to everyone. I would hazard to guess that nationally we may have seen the bottom, because I don't believe the Bank of Canada is going to have to raise rates further from here. And if they do, it's another quarter. So, I believe most of the bad news on rates is already in. I'm not 100% convinced it's completely been absorbed in the market, but I'm very impressed at how well the real estate market has dealt with the rise in rates, including the two latest rate hikes by the Bank of Canada. I suspect, and if we look at it nationally, we're probably going to see the market more or less going sideways over the next 6 to 12 months. Again, there's going to be big differences by regions. But if we look at it nationally, and by the way, it just so happens that the Toronto area has been pretty close to the national average for the past year or so, I suspect that things are going to be more or less fighting to a draw in terms of home prices. A number of metrics suggest the market's actually relatively balanced now. It's neither a seller's nor a buyer's market at this point. And, of course, that pendulum has swung pretty wildly in the last 18 months back and forth. But we now find ourselves, at least nationally, fairly well balanced. And so my best guess at this point is we probably have passed the worst. But I wouldn't expect a quick turn up, not with long-term interest rates still under upward pressure here.
I'm just thinking about something we've talked about for a number of times. We come back to it all the time on the podcast about at least the Vancouver real estate bubble. It seems like the Canadian housing bubble now is a story. The IMF said that we were the riskiest of 27 developed countries. You've mentioned our household debt being way out of line with where it was, say, 15 years ago. What's BMO's take, and I guess Doug Porter's take on the idea of the Canadian housing bubble, and how at risk are we?
So all I will say is I've been hearing the bubble commentary for a long, long time. It wasn't so long ago that people were fretting about overbuilding and a crash in Canadian housing, as recently as about 2012, 13, even 14. And of course that, history has proven made a mockery of those kind of calls. If anything, the conventional wisdom has gone exactly to the other side. Now we have, this desperate shortage of homes. Of course, no less an authority than the CMHC is saying we have to build X million homes. We're always going to be unaffordable. By the way, we don't totally buy into that either. We don't think it's nearly that extreme. I certainly think there is some risk in the housing market. Could it correct again? And I guess this goes back a little bit to the last question. There certainly is a risk, especially if the Bank of Canada gets frustrated with the inflation outlook and feels the need to move up short-term rates even more. That would put the housing sector at some further risk. But I will say, one thing the Canadian housing market has going for it, not everybody would see this as a positive, but it does have going for it, is just the incredibly strong population growth that is underpinning the market. Interest rates over the near term will dominate that factor, but over the medium and longer term, demographics really do hold sway. And that is a powerful source of support for the housing market. So, I think there's no question about that. So even if we did have a further correction in home prices, I suspect it wouldn't last that long. Like I don't think we're at the same kind of risk that that the U.S. housing market went through in 06, 07, 08, 09. I just don't see us repeating that experience. Very, very different dynamics here in Canada than the U.S. So that's a long way of saying, yeah, I agree. There are some risks in the Canadian housing market, but there are some good reasons why prices are so high in this country.
Doug, we talked earlier a little bit about where the rates are now, and there might be still a little bit of uptick there. And I guess from a doomsday scenario, what would potentially drive rates higher than where they're at right now? I know you talked a little bit about how the government maybe be a little uncomfortable with the core inflation numbers right now and that. But if things don't improve or things continue to go in the opposite direction, what would be like a worst case scenario these rates might look at? Like what has to happen for the Canadian government to say, hey, or the BOC to say, hey, we're going to continue to push rates up just, until it's like almost unaffordable? Is that a scenario that potentially might play itself out?
It is. And I don't want to downplay that. That's certainly not our baseline view, but I would give it about a 15 to 20% chance that, we get into a situation where the bank really has to slam on the brakes. And I doubt they'd be alone. Like this would probably be more of a global issue, where the Fed feels frustrated, that there's just no progress on inflation. Like the last thing central banks want to see is an inflationary mindset really get locked in and people just come to accept 4 to 5% inflation or higher. And, what could lead us there? Well, if we got another spike in oil prices or food prices, that could trigger, another wave of near-term inflation that feeds into broader inflation expectations. If the North American economy remains robust, and we start to see very strong wage increases, that sort of feed on itself as well. Maybe combined with strong energy prices, and we'd probably get an indication that underlying inflation, not only is it not moderating, it's actually starting to pick back up again, and maybe we get another energy price spike. Those are the kind of things that I get quite concerned about. That the central bank just lose patience and feel like they have to slam on the brakes. And I don't totally rule that out. If you look at financial pricing, market pricing, or the consensus forecast of economists, almost all of us think that rates are going to come down next year, to varying degrees. But almost everybody thinks that, the Fed and the Bank of Canada are going to be at least trimming interest rates by late next year. And I would just throw out there, a lot of people thought that a year ago. And, here we are still talking about possible rate hikes. So, never say never. It is possible that it's going to take, more to really quell inflation. And I think that is a realistic risk.
One thing over the last couple of years, I think especially since COVID, it seems like forecasting has gotten much more challenging. At least that's what it seems like. Is it, say, from 6 months or a year ago or even 18 months, is it getting easier to forecast in your mind now? Or does it remain really, really challenging?
I think it's easier. 2020 and 2021 were incredibly tough to forecast because, look, basically what we were trying to forecast is where the disease was going and how governments would react to it. And then, how would consumers and households and businesses then react to that? It was just like playing, 4-dimensional chess. And frankly, it was a situation none of us had ever seen before. And then, we had the added element that could we trust the economic data that was being produced at the time? It was just so wild.
Mm-hmm.
We'd never seen numbers like that. I would say we're back more in a conventional world. It's definitely a little bit different than, what many of us have dealt with in the last 30 or 40 years, but it's not unheard of or unseen before. Like we're not having to guess, whether COVID's going to have another wave or not, and, whether the government's going to shut us down or not. We don't have to make those kind of forecasts anymore. So I think it's a bit easier now. Well, it's a lot easier now than it was in 20 and 21. I would say it's a little bit tougher than it was before COVID, but not. I don't want to make excuses because we're dealing with more conventional factors that economists should be able to deal with now. So it's definitely a little trickier. Actually, the other day, Jay Powell was asked that question directly in his press conference, and he frankly said the Fed is having a harder time forecasting these days, and it's probably true, but I don't think we should you really use that as a crutch or an excuse. I think we should still get the broad directions right at the end of the day, because as I said, we're dealing with much more conventional forces now.
Doug, I feel like in the last, especially in the real estate world, everybody's become interested in employment data and all these things that we never used to care about. Is there one data point apart from, say, the Bank of Canada meeting about the overnight rate that you feel like is not talked about or understood enough that everybody should be watching?
It depends how obscure you want to get. But I would say the one indicator that, frankly, even economists didn't pay much attention to, it was out there all the time, but we never really paid that much attention to it before the last couple of years, but it's become pretty important, are the monthly job vacancy numbers. And both Canada and the U.S. produce them. And they give you a pretty good indicator of how tight the job market is. Now, a lot of people have said, some of those job vacancy numbers are a bit bogus because, firms might be advertising jobs that they don't actually have. It's almost like a defensive measure to keep as stable as possible workers. But, even to me, that's a signal. If firms think they have to have, have to be able to looking just in case, that gives you an idea that they think things are tight. And it's interesting, the job vacancy numbers basically peaked in late 21 or early 22. That's when the job market was at its most tight. And in both countries, those numbers have come down, but there's still a lot more vacant jobs reportedly than there were before the pandemic. And that's kind of to me a key to watch is how quickly are those vacancies coming down? Because if they really start to come down, that'll give the Fed and the Bank of Canada some sense that the job market's loosening and they don't really have to slam on the brakes much more. So that's a new, somewhat more obscure indicator that we're paying attention to. But if you're talking about broad numbers, the two most important still out there are the monthly job numbers that actually are separate from the job vacancy numbers. So the unemployment rate, I think is the single most important number in the employment numbers, and definitely the CPI report, the consumer price index in both. Ultimately the Bank of Canada is targeting inflation, so the consumer price index report is the single most important economic report that is produced every single month.
Last question for you, Doug, and we really appreciate your time. What will be the headline for the rest of 2023 and 2024?
So, I'm often asked what keeps me awake at night, and frankly, it isn't economic factors; it's geopolitical factors. And what's the kind of thing that could tip us into a downturn now? The economy is somewhat fragile at this point after the rate hikes. I think it is, some of the geopolitical risks that are out there that are probably most threatening. And it's interesting, of course, in 2024, a lot of countries are going to have elections, including the U.S. And I think realistically, next year will be dominated by the 24 election. I think that's going to absolutely, it's probably going to dominate economics in the year ahead. And frankly, the election, the coming election, politics could even somewhat make the Fed and the Bank of Canada a bit shy, especially the Fed, about raising interest rates further. They do not want to become a political football. They don't want to become part of the conversation. The Bank of Canada at points has been part of the political conversation here in Canada. So in a word, I actually think politics and geopolitics are actually going to dominate over the next year. But that's a bit out of my scope. I would say hopefully the story is going to be that inflation has come down a bit and we're finally looking at some interest rate relief by the end of next year.
I hope so too, Doug. All of our listeners will be familiar with you, but if they're looking to find out more about what you're doing yourself and over at BMO, where's the best place to go?
You can just Google BMO Economics, and almost all of what we produce is available on our website. And I would encourage your listeners to take a look and poke around. I think we have lots of great stuff there. And, like I said, you don't need a password to read most of our stuff or look at our forecast.
Well, Doug, thank you once again for taking the time to join us today. All of our listeners appreciate it no end, and we look forward to hopefully having you back on in the near future when we see the rates start going in the right direction.
Cory, Matt, thanks for having me, and great talking to you.
Excellent. Okay. Thanks so much, Doug. Take care.
Bye now.
Bye-bye. There you have it, folks. Our interview with the one and only Doug Porter, Chief Economist, BMO. I don't even know where to start.
This is one where I'm going to listen again.
Yeah, you have to.
Yeah, because I feel like there's a lot of things he said that I'm processing. I'm in the processing stage. This is how it works. Doug's processing very quickly, as it says, is very obvious. We're gonna listen back, take a week, listen again to really get everything out of this. But man, what a great episode.
One takeaway I had there is he's talking about, where do rates go back to when they get back there? And I think a lot of people, especially people in the real estate business, if you were looking at kind of where we were in like late 2020, 2021, maybe even early 2022, and we're still dealing with like COVID type interest rates though. If you're buying assets and you need those type of cap rates and interest rate numbers to make your investments work, I think you have a challenging 2025, 2026 ahead of you when those numbers come due for refinancing, because those were, outliers when it comes to how rates were going to go. And I think Doug made a good point talking about where do they go when they're coming back. And one thing that, I never really put as much thought into this, but obviously it's he does, is the rates we saw kind of pre-COVID were probably still like the slight tailwinds we were feeling from the financial meltdown. That's why they were where they were. So I think if you're looking at numbers thinking it has to go back to like pre-COVID interest rates, we might not get back there. So we might be dealing with a little bit higher numbers moving forward, and that might be the new norm.
Or even the old norm.
The old norm, yeah.
Yeah.
Pre-financial meltdown there. So I think that was good. He talks about the BOC rates, maybe potentially getting back to that 2.5%, 3%. That doesn't mean that you're going to go to BMO and get 2.5%, 3%. That's what the Bank of Canada's overnight posted rate is. You're going to show up at BMO and probably get like 4 to 5% type of thing. So,
but I'll gladly take it.
Oh, yeah, right now?
Stage, I'll gladly take it.
I'll take 6 right now.
The other thing that I just was maybe a bit more depressing, and I'm not sure, I hope I'm wrong about this, or I hope Doug's wrong about this, but I don't think he is. The headline for 2023, 2024 being all political and what's geopolitical, and also the upcoming elections especially in the US. I'm just so sick of that stuff. I can't even imagine if that's dominating the next year. I want to turn off. But
well, I think there's so many things that feed into that, right? And like if you look at the Liberal government here in Canada, Justin Trudeau came out and they talked about getting rid of the GST on purpose-built rentals, which was a promise I think made 8 years ago.
Yeah,
but it's clearly made leading up to what's going to happen next year and how that will impact. And we're very fortunate when that news came out. I went to a good friend of the show, Byron Chard, who I might be overstating this, but I think they've got like 2,000 or 2,500 rental doors coming down the pipeline. Right. So who better to ask than a chartered accountant by trade that now is CEO and president of one of the biggest development companies with that much work and that much purpose-built rentals. So I reached out to him right away. I said, hey, would you come on and talk about this? Because you're living this.
Yeah.
And he was jumping at the opportunity. So we're very fortunate we have him coming on. But just getting back to the point about the Liberals, there's things starting to leak now. They're going to lead into next year. And I think this whole economy situation is going to be, top of the political charts, right? Did the Liberals or did the government put us in this position? Did they react too slow? Did they give out too much money? It's all hindsight now, but I think it's going to be top of mind during the whole political race of how this impacts us moving forward.
It puts me in mind of a line Doug Porter said.
Yeah.
The flight never really ends.
No, the plane might run out of gas, but just keeps going.
Cory, how can people find out more about what you're doing over at William Wright Commercial?
They can reach out to me anytime. They can send me an email, Cory@williamwright.ca. You can visit our website, williamwright.ca, sign up for the latest and greatest news, or you're always welcome to call our Vancouver head office, 604-428-5255. Tell us what you're looking for, and we will gladly put you in touch with the best broker in the province.
And of course, all these episodes do end up at VancouverRealEstatePodcast.com. That's our website where all things real estate related live, both commercial and residential. You can search specific as you want to get topics on the site and go back to listen to evergreen content. I would encourage everyone to do so at VancouverRealEstatePodcast.com. And I think that's another week in the can, Cory.
Another week. We've got some great episodes lined up there. We've got Buyer and Chard coming up. We're going to talk all about what does this GST mean for purpose-built rentals. And I think for people that probably don't operate in that world, the general consensus is if you build a purpose-built rental building, so you're creating, housing, and you keep the building, you don't stratify it and sell it off to the end consumer, you as that building owner are going to pay the government your 5% GST just to keep the property. Yeah. So, people might be scratching their heads and think that doesn't make any sense. Right. Well, when you
Why
sell,
are you disincentivizing people from building houses?
So if I have a building,
especially purpose-built rental.
Well, but if I have a building when it's done and it's worth $100 million, now obviously I'm going to have some input tax credits to offset this a little bit, but the general consensus is I'm writing a check for $5 million when I'm done. And it never really made a lot of sense. I understand that governments get addicted to taxes, and I get that, and I understand where they go. And I'm believe it or not, I'm happy to pay my taxes in this country because they go to good things. But it just doesn't make sense. So we're struggling for housing. We have record-setting construction costs right now, record-setting land prices, record-setting immigration numbers, and I want to build housing, and you want to dip back into my pocket and make it more unaffordable for me to build housing that you need. So got Buyer and Chard coming up on there. We got John Switzer from Impact coming up. He's going to dive into all the rates and how the bonds market affects the interest rate market. So he's going to jump into all of that stuff. We got him coming up next week because I wanted to back up Doug with John. John doesn't even know how that we can even say his name in the same sentence as John, as Doug, sorry. But we want to have him where are rates? What's going on in the commercial lending world? So we have him coming up, and we got a whole bunch of financial information and economy stuff coming up for everybody.
Fantastic. Have a good week. We'll be back next week.
Thanks for listening.
Subscribe today.